So I am proposing a permanent institution that I call, for lack of a better term, a U.S.-China Secretariat that meets full-time, 24/7, staffed by an equal number of professionals on both sides of the relationship, whose full-time job is to deal with all aspects of the relationship, from economics and trade to cyber and human rights. And we need a new approach, and this is, one idea may not be perfect, but it certainly beats the current failed approach.
Stephen, there might be a lot of uncertainty on the policy side, but businesses have to make moves. They have to either expand and double down on their expansion plans in China, or they have to withdraw, which we've seen a number of companies do on the margins. And we hear more and more about reshoring or onshoring of U.S. companies away from China. How materially will that shift the dynamic of trade at a time when a lot of people say this will be inflationary?
Well, I think it will be inflationary. I think that the trend toward reshoring is an unmistakable outgrowth of geostrategic tensions between the United States and China. They can better be addressed through a structure such as the one I just outlined, Lisa. But make no mistake, this is very destabilizing, not just for the U.S. and inflation, but also for China. China benefited the most of any nation in the world from the upswing of globalization, and it has the most to lose, I think, as we now move from globalization to deglobalization.
So there's a larger issue, though, for the economy, and this is something that we were just hearing about from Ron Temple, how he thinks that perhaps we'll get back down to a 3% inflation rate, but not much below that because we are in a new paradigm. And I wonder, how much is China the main part of that? If you have reshoring, which incurs more expense, and you have slower growth in China because of exactly what you said, because this is going to affect the world's second biggest economy significantly, how much does this portend a slower growth, higher inflation environment for a longer term?
Well, we debate how much China has held down U.S. inflation over the past 20 years, but it's been significant, as has the rapid expansion of global value chains or global supply chains. And as supply chains are disrupted by China and other developments around the world, as we move from offshore to onshore, good luck in getting inflation down to 3. It's going to be a very difficult goal to achieve.
Steve, I've been dying to ask you this. You built Morgan Stanley Economics. You were the first American economist I know that tried to make a 3-leg Fed policy of unemployment and inflation. And you said, watch the balance sheet, the expansion of the balance sheet. All that came true, as you wrote about years ago. What's the Fed theory now? If you were to parachute into Jackson Hole here at the end of August, what is the theory you're going to find about central banking?
Well, hard for me to know how they're going to phrase it, Tom, but I think the Fed theory has got to go back to basics. Forget this QE, balance sheet, asset-dependent economy. It's blown up repeatedly since Greenspan and Bernanke tried it in the 90s and the early 2000s. The Fed's got to go back to inflation targeting, not average inflation targeting, but plain old inflation targeting. And we need a dose of the very simplistic but tough and disciplined approach by Paul Volcker. Jay Powell says he's very much committed to doing this. The Fed's taken some big steps, but it's, child play compared to what they have to do. The real federal funds rate is still sharply negative. You're not going to control inflation with a sharply negative real federal funds rate.
That's on the LM side. Okay, help me here with the real economy and the unemployment rate. If we go all Lawrence Summers this morning and pop it up, as Anna Wong at Bloomberg says, to a 4% or 5% regime,